Welcome to Currency Secrets. Turn headlines into profit-aware insights. The Trump shock sequence. How a single policy signal unwound Bitcoin, broke dollar confidence, and cracked gold's bid. What you are watching is not a random cross-asset tantrum. And it is not a personality story, it is a system story. The claim is simple and uncomfortable. When political power injects uncertainty into the world's reserve currency plumbing at the same moment leverage is high and collateral is fragile, three things crack in sequence: speculative duration first, currency confidence second, and monetary hedges last. That sequence has repeated across eras because it is not psychological, it is balance sheet math. Recent estimates put U.S. federal debt above roughly $36 trillion, with an unusually large share needing refinancing in short windows relative to modern norms, while global dollar-denominated liabilities remain enormous across sovereigns, banks, and corporates. You do not need perfect precision on any single number to see the mechanism. The scale is enough. Once refinancing pressure, policy volatility, and collateral repricing intersect, the reaction function is constrained. The pattern becomes probabilistic, then mechanical, then inevitable. In this frame, the Trump shock is less about one statement and more about the system's sensitivity to policy signal under late cycle conditions. A headline can change expected tariffs, expected deficits, expected growth, expected retaliation, expected inflation, and expected Fed reaction in the same hour. Markets then reprice that bundle through the only channels they have: rates curves, dollar funding spreads, FX basis, equity volatility surfaces, commodity term structures, and collateral haircuts. Bitcoin is treated as high beta liquidity and narrative duration. Gold is treated as monetary insurance until forced deleveraging liquidates insurance to meet margin. The dollar is treated as safe haven until confidence in policy coherence collides with supply, rollover, and twin deficit arithmetic. If you understand that interaction, you understand why assets that are supposed to hedge each other can fall together for a violent window. Every cycle starts with a setup phase that feels stable because its fragility is hidden inside market structure. In the setup, institutions lock in assumptions. Auctions will clear smoothly, foreign demand for sovereign paper will remain elastic, inflation will glide lower, and liquidity will appear on schedule whenever funding markets cough. Risk models are built on recent volatility, not on structural shifts. Dealers warehouse duration based on expected balance sheet capacity. Asset allocators extend into crowded trades because carry works, until carry is asked to survive a regime change. In this phase, paper claims multiply faster than deliverable collateral. The system still functions, so confidence rises. But the important point is this: confidence rises precisely because the hidden dependency network has thickened. Stability is not the opposite of fragility here, it is the masking layer above fragility. Then comes expansion and debasement. Not always as textbook money printing, but as broad nominal overextension. Governments expand fiscal promises relative to tax capacity. Private markets expand leverage relative to high-quality collateral. Central banks, trying to smooth employment and growth cycles, often underprice future inflation variance. The currency does not collapse immediately. It dilutes slowly through policy asymmetry. Political incentives bias toward short-term support, not long-term balance sheet hygiene. In this expansion phase, demand for hedges grows, but so does demand for risk, because nominal growth narratives remain seductive. Precious metals can rally while real yields briefly fall, then stall when yields spike. Bitcoin can surge on liquidity optimism, then become a funding source when liquidity disappears. The paradox is that expansion creates both the mania and the future forced selling that kills the mania. Crisis begins when control variables stop obeying policy messaging. Yield curves move the wrong way. Auctions tail despite reassuring language. Cross-currency basis widens when it should be calm. Volatility clusters instead of mean reverting. The crisis phase is not one crash print. It is a loss of control over transmission. Policymakers may still command headlines, but markets command financing terms. Once financing terms decouple from narrative, every actor recalculates. Governments recalculate interest burden. Banks recalculate duration risk. Corporates recalculate rollover feasibility. Households recalculate purchasing power. At that point, monetary and fiscal authorities are no longer choosing from a menu. They are triaging constraints. And then the inevitable outcome appears: explicit devaluation, implicit financial repression, structural inflation volatility, or some hybrid of all three. The exact label changes by era. The arithmetic does not. Excess claims must be reconciled with real capacity and acceptable defaults. If defaults are politically constrained, currency absorbs the adjustment. If currency defense is prioritized, growth absorbs the adjustment. If both are defended simultaneously, volatility absorbs the adjustment first, and policy credibility absorbs it second. This is why late cycle breaks feel chaotic but resolve in familiar ways. The surface is new, the settlement equation is ancient. To see this clearly, you have to strip away branding and revisit history through the same mechanism. Start with the United States from the late 1960s into the 1970s, culminating in the Nixon shock and the stagflation decade. The setup looked durable. Bretton Woods anchored the dollar to gold at $35 per ounce. Allies held dollar reserves, and post-war growth created confidence that U.S. fiscal and external balances could be managed without rupture. The system worked so well that it encouraged overconfidence. Dollar liabilities expanded globally, while the underlying gold convertibility promise became harder to honor. The exorbitant privilege was real, but privilege invited overextension. Expansion arrived through a combination of fiscal pressure and monetary accommodation. The Vietnam War and Great Society spending expanded nominal claims. External deficits grew. Foreign central banks accumulated dollars and, crucially, began questioning convertibility sustainability. The U.S. could either tighten brutally, risking domestic recession and political backlash, or preserve growth and hope. Confidence held. Confidence held until it didn't. Debasement in this context was not a single policy declaration, but a gradual mismatch between the stock of dollar claims and the credibility of gold settlement at fixed parity. Crisis became visible in the late 1960s and early 1970s through repeated strain events, pressure on U.S. gold reserves, speculative flows, and official sector attempts to manage parity expectations. The London gold pool collapsed in 1968 after coordinated efforts to maintain gold price stability failed under demand pressure. By August 1971, President Nixon suspended dollar convertibility into gold. That decision is often told as a geopolitical pivot. Mechanically, it was a settlement failure under fixed convertibility promises and expanding claims. The control variable, confidence in dollar-to-gold conversion, had broken. Policy did not choose ideal outcomes, it chose survivable outcomes. The inevitable outcome followed exactly as the mechanism predicts. The nominal anchor was severed. Inflation volatility rose through the 1970s, worsened by oil shocks, but not caused by oil alone. Bondholders suffered deeply negative real returns for years. Gold moved from fixed price restraint into free price discovery and repriced violently higher over the decade as trust in fiat discipline deteriorated. Silver experienced explosive swings, including sharp spikes and brutal reversals, reflecting both monetary anxiety and thin physical market structure vulnerable to speculative pressure. The lesson is not gold always up. The lesson is that when settlement credibility breaks, precious metals become monetary stress gauges. They can overshoot, seize, and gap because paper promises and physical availability are different markets sharing one ticker symbol. That paper versus physical distinction matters more than most commentary admits. In calm regimes, futures and spot pricing stay tightly linked through arbitrage, inventory, financing costs, and delivery optionality. In stress, the linkage can stretch. Futures markets can show abrupt liquidation as leveraged participants de-risk, while physical premiums rise in specific jurisdictions because fabrication capacity, logistics, and retail fear distort local supply demand. Exchange inventories can appear ample at headline level, yet be less available at marginal delivery terms due to ownership, warrant status, and financing frictions. A chart of price alone hides this structure. During monetary stress, what clears on screen and what clears in vault pipelines can diverge long enough to matter for policy and portfolio decisions. Now map the second case, the road to Britain's 1992 ERM crisis, where the pound's defense under a semi-fixed exchange rate framework collapsed under rate, credibility, and reserve constraints. The setup phase looked institutionally respectable. The UK joined the exchange rate mechanism in 1990, committing sterling to a band against the Deutsche Mark, signaling anti-inflation seriousness and European monetary alignment. The commitment was meant to import discipline. Markets initially rewarded the framework because rules reduce uncertainty, until rules conflict with domestic macro reality. Expansion and overextension emerged through policy mismatch. UK inflation dynamics and growth conditions diverged from Germany's. After German reunification, Bundesbank policy stayed relatively tight to confront inflation pressure in Germany, effectively exporting restrictive monetary conditions to ERM participants linked to the mark. Britain, already contending with weakening domestic conditions, faced the impossible trinity in real time. Fixed exchange rate commitments, domestic policy autonomy, and open capital flows cannot all be maximized simultaneously. Authorities still attempted to hold the line, using reserves and rate policy to defend parity credibility. That defense consumed capacity and invited speculative testing. Crisis arrived when markets concluded policy would not sustain the cost of defense. Sterling came under intense speculative attack in September 1992. The Bank of England intervened heavily and announced emergency rate hikes, including a dramatic same-day increase signaling desperation rather than control. Funding conditions tightened, but credibility deteriorated faster than policy could restore it. Once participants believe a peg is misaligned, defending it becomes a one-way transfer from official balance sheets to speculative capital willing to absorb temporary pain for structural gain. The attack is not merely a bet against a currency. It is a bet against finite reserves and finite political tolerance. The inevitable outcome was exit and devaluation. Britain withdrew from the ERM on Black Wednesday. Sterling fell. In the short run, the event was framed as humiliation. In macro terms, it was the resolution of an unsustainable policy configuration. The mechanism again held stable setup, expansion into mismatch, crisis via control variable failure, then a forced realignment that policy had tried to postpone. And again, markets that appeared disconnected were linked through funding and credibility. Bond yields, FX forwards, and policy rates were not separate stories. They were one story about who absorbs adjustment losses and when. Why do these two cases matter for today's Bitcoin dollar gold sequence? Because both show that crisis is not born at the moment of headline panic. It is manufactured over years by accumulating promises against constrained settlement channels. In one case, the constraint was gold convertibility under reserve pressure. In the other, it was an exchange rate commitment under capital mobility and policy divergence. Today, the constraints are different in form but similar in force. Massive sovereign refinancing needs, politically charged fiscal trajectories, global dependence on dollar funding, fragmented supply chains that convert FX moves into inflation bursts, and financial market structure where passive flows and derivatives magnify intraday dislocations. When a large policy signal hits this architecture, it does not need to be new information in the academic sense. It only needs to alter the expected path of three variables: nominal growth, inflation pass-through, and policy reaction. Markets then do the rest. Treasury yields can rise on growth optimism and inflation fear simultaneously, which tightens financial conditions through mortgage rates, corporate borrowing costs, and equity discount rates. A stronger dollar can coexist briefly with risk-off flows, but if deficit and issuance anxiety rises, the same dollar can lose confidence premium against select counterparts even while emerging market stress intensifies. That is currency stress transmission, not one direction, but unstable correlations. In that instability, Bitcoin behaves like global liquidity beta, not digital immunity. It rallies when marginal dollars are cheap and confidence in policy restraint is low but orderly. It breaks when funding costs jump and collateral calls force liquidation. Gold behaves like policy credibility insurance over medium horizons, but can sell off in acute squeezes when funds monetize winners and hedges to meet redemptions. Silver adds an industrial demand layer and thinner market depth, so its swings are often sharper, especially when manufacturing expectations and monetary fear collide. This is why the same macro shock can hit all three simultaneously for a window that feels illogical to single asset narratives. The real stress theater, however, is usually the bond market. Sovereign auctions are periodic truth tests. If bid to cover weakens, tails widen, or indirect demand softens persistently, yields must adjust to clear supply. Higher yields then raise projected interest expense, which feeds fiscal anxiety and can demand still higher term premia, a reflexive loop. Dealers constrained by balance sheet costs cannot absorb unlimited duration without compensation. Money market funds, banks, foreign reserve managers, pension funds, and leveraged relative value players each respond to different constraints, so demand elasticity fragments exactly when supply is heavy. That is when volatility stops being noise and becomes policy data. Once volatility becomes policy data, central banks face a credibility trilemma: tolerate tighter conditions and risk recessionary deflation impulses, ease too quickly and risk reigniting inflation expectations, or alternate signals and risk both. None of these paths is clean. In each, FX transmits stress globally. Import-dependent economies face pass-through pressure when their currencies weaken. Export-driven systems face margin pressure when global demand slows. Dollar borrowers face refinancing pain when spreads widen regardless of local inflation trends. The world then rediscovers that the dollar system is not a metaphor. It is the settlement lattice through which crises propagate. And in that lattice, metals are not a side plot. They are the readout of trust. Paper markets can absorb vast notional turnover relative to immediately deliverable physical supply, which is efficient in normal times and destabilizing in panic. As uncertainty rises, the desire to convert claims into allocated metal rises unevenly across participants. Premiums can widen at coin and bar level even if headline futures prices are falling, because retail and regional demand spikes interact with fabrication bottlenecks and distribution frictions. Inventory drawdowns at key hubs can become narrative catalysts, but the deeper signal is whether confidence in future deliverability durability at acceptable basis remains intact. If that confidence degrades, volatility in metals is no longer merely speculative, it becomes systemic communication. This is why the Trump shock sequence deserves to be read as mechanism, not drama. A political jolt reprices inflation path, trade path, fiscal path, and policy path. That repricing moves yields and funding. Funding stress forces cross-asset liquidation. Correlations invert. Hedging assumptions fail. Then, after the forced selling phase, monetary hedges and real collateral begin separating from high beta proxies. Most observers only notice the middle, the crash prints. The crucial information is in the plumbing before and after: auction quality, basis behavior, delivery preference, inventory mobility, and FX stability under pressure. History shows the same warning in different costumes. When promises outrun settlement capacity and policymakers defend narratives past their shelf life, markets perform the correction with blunt tools. First by repricing time, then by repricing trust, finally by repricing money itself. The first two historical proofs are already on the table. They were not accidents and they were not isolated. They were the same structure resolving under different institutions. The only question that matters now is whether the present system has already crossed from expansion into loss of control, because if it has, the next move will not be decided by speeches, campaign optics, or one-day rebounds. It will be decided where all such episodes are decided: in rollover math, in auction clearance, in dollar funding spreads, and in the widening gap between paper confidence and physical preference. The liquidity trap tightens. Why bond stress, FX fractures, and precious metals volatility point to the next global reset. If the system's verdict is written in rollover math, auction quality, and the widening distance between paper claims and physical preference, then the final historical proof has to be a case where policymakers tried to defend confidence with scale, speed, and institutional sophistication, and still lost control of transmission. That case is not ancient history. It is the United Kingdom in 2022, the gilt crisis that followed the September mini-budget. A developed market, reserve currency adjacent credibility, deep pension institutions, advanced central banking, real-time market surveillance, every modern safeguard was present. Yet once fiscal signaling, inflation uncertainty, and duration supply collided with leveraged liability-driven investment structures, the market forced a correction in days, not years. The setup had looked stable. Long years of suppressed yields, assumptions that sovereign duration remained the safest collateral backbone, and pension hedging frameworks built for gradual moves. Expansion was clear. Pandemic-era fiscal layering, energy shock exposure, and aggressive policy support left nominal balance sheets swollen while inflation variance stayed elevated. Crisis erupted when unfunded tax cut signaling hit an already fragile rates complex. Long-end gilt yields exploded higher, margin calls cascaded through LDI portfolios, forced selling fed further yield spikes, and the Bank of England had to intervene with temporary bond purchases to halt a self-reinforcing spiral. The inevitable outcome was political reversal, policy retreat, and a public demonstration that developed market bond plumbing can seize when leverage and collateral assumptions break at once. Check. Now apply the mechanism to the present system, step by step, where the US dollar sits at the center of global settlement, and every major asset class takes its cue from the price of time and treasuries. The first step is the USD system itself. The dollar is not just America's currency, it is the world's invoicing unit, collateral reference, and funding language. That means global trade, sovereign reserves, commodity pricing, bank liabilities, and derivatives margining all carry a dollar dependency. When U.S. policy uncertainty rises while Treasury supply remains heavy, the world does not get a local story. It gets a global repricing impulse. Even economies with modest direct U.S. trade exposure feel it through funding costs, import bills, and portfolio flows. If the anchor wobbles, everything tied to the anchor starts recalibrating simultaneously. Verified. The second step is FX fracture, and it rarely appears as one clean directional move. In early stress, the dollar can rise against growth-sensitive currencies because global risk is being cut and dollar cash is hoarded. Later, if term premium rises and fiscal credibility is questioned, the dollar can weaken against select safe alternatives or real asset proxies even as emerging market currencies remain under pressure. That split behavior confuses narratives but confirms mechanism. One channel is safety demand, the other is confidence in policy mix and sovereign duration absorption. Watch cross-currency basis and front-end FX swap pricing. When hedging dollar exposure becomes persistently expensive, that is not noise. It is stress transmission through the balance sheet channel. Undeniable. The third step is inflation-deflation dynamics, where people expect a single outcome but get alternating waves. A tariff threat, supply route disruption, or currency depreciation lifts tradables inflation and headline prints, while tighter financial conditions, weaker credit creation, and inventory correction pull toward disinflation in domestic demand. The result is unstable inflation composition, sticky services, volatile goods, and policy confusion about which component deserves reaction. Markets then oscillate between higher for longer and growth scare in compressed cycles, which destabilizes duration positioning and amplifies volatility in real yields. That instability matters more than the monthly CPI headline itself because financing decisions are made on expected path variance, not one print. Check. The fourth step is debt rollover pressure, where arithmetic starts dictating policy bandwidth. Large sovereign refinancing calendars force repeated auction exposure at prevailing yields. If average funding costs drift higher faster than nominal revenue growth, interest expense crowds out policy optionality. Corporates face the same geometry. Bonds issued in low-rate years mature into higher coupons, reducing buyback capacity, capex flexibility, and labor buffer resilience. Households are slower because mortgage structures differ by country, but consumer credit and floating rate debt transmit pressure with a lag. The key point is cumulative refi gravity. Each rollover date converts yesterday's assumptions into today's cash expense. Verified. The fifth step is auction quality. In benign regimes, auctions clear with healthy bid to cover, modest tails, and stable indirect demand. In fragile regimes, you start seeing softer bid to cover at the margin, wider tails versus when issued levels, and a greater clearing burden on price-sensitive buyers rather than reserve-mandated buyers. Dealers can warehouse only so much without demanding compensation, especially when balance sheet costs rise and repo conditions are less forgiving. If auctions clear but at increasingly punitive yields, that is still stress. It cleared is not equivalent to it is stable. Term premium then rises as investors demand extra compensation for duration uncertainty, fiscal trajectory risk, and inflation variance risk. Undeniable. The sixth step is yields, real yields, and swap spreads, where plumbing tells you whether the move is healthy repricing or structural strain. A moderate rise in nominal yields with stable or falling real yields can reflect growth optimism. A sharp rise in real yields with widening volatility usually reflects tighter financial conditions and collateral stress. Watch swap spreads for dislocation signals. Unusual behavior in long-end spreads can indicate balance sheet constraints, hedging imbalances, or treasury-specific supply pressure. If swap markets and cash treasuries stop moving in their usual harmony, transmission is fraying. That is when risk systems anchored to historical correlations begin failing in sequence. Check. The seventh step is dollar funding stress in money markets, often visible before broad narratives catch up. FRAOS behavior, SOFR futures repricing, commercial paper demand, and offshore dollar borrowing costs begin to signal caution. Banks and non-banks hoard high-quality collateral, tenor shortens, and funding desks prioritize certainty over spread pickup. Cross-border borrowers pay up for dollar term funding, and hedging demand lifts basis costs. What looks like a technical money market adjustment is actually macro tightening transmitted through the core financing channel. If cash certainty is prized over return, the system is moving from expansion logic to survival logic. Verified. The eighth step is basis trade fragility and repo dependence. Relative value funds often run levered trades that assume stable spreads between cash treasuries and futures, financed through repo with tight haircuts. In calm periods, this adds liquidity and compresses dislocations. In stress, volatility jumps, haircuts rise, financing lines tighten, and even sound trades are reduced because gross exposure becomes intolerable. Forced unwinds then widen the very basis that was assumed mean reverting, pushing more deleveraging and creating a reflexive loop. Repo is the bloodstream here. When collateral velocity slows, market depth thins across assets that appear unrelated on the surface. Undeniable. The ninth step is collateral hierarchy and liquidity squeezes across risk assets. When high-quality collateral becomes dear and financing conditions tighten, portfolios sell what they can, not what they want. That is why Bitcoin, high-beta equities, and even safe hedges can drop together in the acute phase. Volatility targeting cuts gross exposure. Risk parity style frameworks de-risk as stock-bond correlation turns unstable. Option dealers adjust gamma exposure, reinforcing intraday moves. Credit spreads widen as refinancing assumptions weaken, which feeds equity risk premium repricing. This is not irrational panic. It is collateral-constrained selling under rising uncertainty of funding terms. Check. The 10th step is where silver and gold move from price story to stress valve story. In a squeeze, futures can be sold aggressively to meet margin, producing sharp downdrafts that commentators misread as hedge failure. But beneath that, physical behavior can diverge. Coin and bar premiums rise in specific regions, delivery preference increases, and certain inventory categories draw down faster than headline totals imply. Exchange stocks may appear sufficient in aggregate, yet immediately deliverable. Unencumbered metal can be tighter at the margin than visible data suggests. Refining bottlenecks, transport constraints, and regional demand spikes create localized scarcity even during global paper liquidation. Verified. Gold's role then reasserts over horizon, not minute. When policy credibility is questioned and real rates become unstable rather than simply high, gold transitions from trade to balance sheet insurance. Silver is more violent because it sits at the junction of monetary fear and industrial cyclicality. When growth scares dominate, it can underperform gold. When policy response and inflation concern return, it can catch up brutally. The gold-silver ratio, lease rates, forward curves, and regional premiums become critical context. Paper pricing remains essential for liquidity, but physical flow data reveals conviction. Undeniable. Now connect this directly to the Trump shock sequence that triggered the initial cross-asset break. A sharp policy signal can push expected deficits, inflation pass-through, and trade retaliation probability higher at once. Treasury supply expectations and term premium respond, yields rise or become more volatile. Dollar funding tightens at the edges. Risk assets derate as discount rates and uncertainty rise. Bitcoin, as liquidity beta, sells first and hardest. Gold can be hit in forced deleveraging, then stabilizes as policy credibility concerns outrun immediate margin pressure. Silver whipsaws through both channels, industrial demand fear and monetary hedge demand, producing the impossible tape where everything is down before correlations rotate again. Check. What keeps the sequence alive is not ideology, but lag structure. Markets reprice instantly. Cash flow statements reset quarterly. Refinancing walls roll continuously. Labor and capex decisions adjust with delay. Inflation data confirms late. That staggered clock creates repeated shocks instead of one clean event. Each rebound tempts the narrative that the system is healed. But if auction metrics remain fragile, real yield volatility elevated, and funding spreads twitchy, rebounds are relief, not resolution. The trap is to confuse price recovery with plumbing recovery. Verified. So what should a serious viewer do with this? First, stop anchoring on single asset opinions and start reading transmission channels. Track Treasury auction statistics consistently. Bid to cover, tails, indirect participation, and dealer takedown trends. Watch term premium direction, not just policy rate headlines. Monitor real yields and volatility because real rate instability breaks both growth and hedge assumptions. Keep an eye on swap spreads and basis behavior for signs of balance sheet strain. Follow dollar funding indicators and cross-currency basis to detect offshore pressure early. In metals, compare futures price action with physical premiums, delivery signals, and inventory category changes rather than relying on one headline chart. Undeniable. Second, think in phases, not predictions. Phase 1 is repricing of expectations. Phase 2 is financing stress. Phase 3 is policy response under constrained credibility. Phase 4 is asset reseparation between liquidity beta and monetary collateral. If you know the phase, you avoid becoming the liquidity exit for faster money. That means less leverage than your conviction wants, more attention to collateral quality than nominal return, and patience when forced selling prints create false certainty. Check. Third, reject comforting slogans that erase arithmetic. American exceptionalism is not a funding model. Tech will save us is not a term premium suppressant. Modern optimism is not a substitute for auction demand, collateral depth, and sustainable real financing costs. Innovation can raise productivity. It cannot repeal rollover calendars or neutralize duration supply overnight. Strong institutions matter. They do not eliminate constraint. They only change how constraint is distributed. Verified. This time is not different. The labels will differ, the apps will be newer, the dashboards will be cleaner, and the explanations will sound smarter, but the adjustment still runs through the same pipes: currency confidence, sovereign duration absorption, funding market elasticity, and the boundary between paper liquidity and physical preference. If you want to stay ahead of the trap, watch the plumbing when headlines are loud, and watch behavior when volatility is quiet, because that is when positioning is rebuilt for the next break. Keep this framework close. And in the next analysis, we will map exactly how the machine was assembled layer by layer, and where the next stress point is most likely to fracture first. The verdict is straightforward. Markets are not waiting for permission to enforce balance sheet reality, and every temporary calm now sits on top of unresolved rollover and credibility risk. If you read the signals early, you keep agency. If you chase narratives late, you become someone else's exit liquidity. When the next auction funding spike and metals delivery divergence arrive together, will you recognize the phase before the crowd does?